So just to be sure, I think you'll see. It should be. You should read it. It's a warning, just to be sure that have fun. We talk about stuff. I don't have a license, and even if I did, I don't want to give you any advice. As never, it is just we will talk about stocks. I will show you numbers. I will say yes, maybe that's good, maybe that's not good, but just to be sure, it's nothing in there to say go and buy, go and sell. It's just for educational purposes. So my not my lawyer, but my good judgment told me to tell you that before this section, and it is obviously good for the whole course in itself. All right, so we go back to the consumer monopoly and talk a little bit more about that, and that is the moat. Buffett talks a lot about the moat because he says that every business is a chateau fort, is a castle, and the profits in the castle. The more the profit, the more the warriors, the more the competition want to come and take that profit away from the company. So he says that a company well built will build a moat. Will build the moat is the thing full of water and alligators and to prevent people to go in. And so let's say you talk about Morningstar because I teach lab advisor. That is the Morningstar. I know lab. It's lab advisor. Yes. So Morningstar has built a reputation, has built a network, and has a moat because they have access to information about stocks and mutual funds and stuff like that, and they are able to take that information and to sell it and to package it in a way. So if you want to do that as a company, it will take time, investment, effort, infrastructure, and stuff like that. And that's why they are thriving and doing well for the last 30 years. Amazon right now, as far as the moat goes, we'll see about the profits and stuff, but as far as the moat goes, Amazon is building itself a huge castle and a huge moat. It's big. It's big what it's doing right now because they are super investing in super electronics and robots and mechanization, and they talk about the last mile of delivery and stuff like that. So they are going for the fences. They are going for the big moat. We'll see if that transcends into profits, real profits into the future. But right now, that's why the markets give Amazon such a valuation because they are building a tons of moat capability. Apple has built a nice moat onto itself because Apple, by the name, by the branding, by the way the design, the whole thing and the ecosystem, people like or dislike, or clearly hate Apple, but they have branded themselves into a luxury company, into a company of nice things for nice people. So they have margins to prove they have built a moat. Google have built a moat because it is the most dominant player into the search engine. It's 85 to 90%. So it's a monopoly, and they are able to charge and to dominate the market. Facebook. So you have many companies in many sectors that has built themselves a nice castle and nice streams of income of profit. And so it is out there. So that is the first thing we have to figure out, and we'll study some of those companies. And we can see by the numbers where they are standing. So I'm showing you right now earnings from two Canadian banks. So bank, I will tell you the name after, but just for now, just for you to be blank and have no idea what I'm showing you. Two banks from 2001 to 2017, earning per share. Bank one, you can see, you can just take that. No need for your calculator. Just look at the different numbers to see there. You see a kind of an uptrend, but 2001 $4 245 minus 79 minus 256 78 78 10 11. So it's not bad. It's a trending. It's upward, but we have some rough patches in the 2000s. The other bank, still Canadian bank, 195 96 2 2 2 3 3. We go back to 3 4 5 6 7. Less spectacular, but much more reliable. So if I tell you which one of those two banks you prefer, usually when I do that in my class, people will prefer the bank on the right as far as stability and the way it's managed. We can say that the bank on the right, at the numbers we see there, it's more stable. I would say it's more conservative. They have taken less risk, and if they have taken risk, it has been on their side. The other bank, trying to be the king of the hill, has taken upon itself maybe too much risk. It hasn't gone in their way, especially in 2008. So it's a bit more difficult. So bank one is the CIBC, and the bank two is the Royal Bank. And we know that if you know a little bit of the two banks, two different mentality. I've worked with both, so that's why I put them there. Great guys, great personnel, great. Nothing to say bad about them, but just to see two different structure of profits. Again, now two U.S. company, two technological, in the techno field companies, different but in the same type of environment. So the company number one, techno one, is 2 cents, 22, 20, 96, and then we go up to $29 worth of profit from 2 cents in 2001. Company number two, we were at a loss in 2001, 2 cents, 1 cent. So in 2003, not bad, 4, yeah, 23, and then it kicked up at from 2008, 9, 10, and then we go boom, 2012, and now we are at $9. So two different companies, nice. The one on the left is there is more profit on the left per share. On the right, a little bit less, but still it's an upward. On the left, you have Google. Okay, you have the Google company, and on the right you have Apple. So you have Apple on the right and you have Google on the left. Now you're in a completely different field, and we have two automakers company. One is North American, the other one is Japanese. I'll let you decide, or just look at right and left, which one is American and which one is Japanese. Usually in my class, it's pretty easy to spot, and I think you will agree with me that the one on the left should and is an American car company, and on the right it is the Japanese company. You can see the American company has been difficult, and all the American companies don't have the real moat. They always on sale. They always try to have biggest deal. They have some problems, and the consumer fidelity, the recurring is not as high, and they have to negotiate the prices, and sometimes they don't have that much of a margin, and it has been difficult in 2006, 7, and 8. In 2001, we have 4 years out of those 16 years that have been at a loss. So it has not been easy, and even today at $1 per profit per share, it's okay, but we are far away from 2011 at $4, and we're far from the loss in 2008 and 2006. But still, it is profitable in the last 8 years. It is Ford, by the way. On the right, you have Japanese companies. It's Toyota. Toyota has a problem in 2009. They have some recalls, and the recession has hit them. But if you look at that, much more stable, just the 1 year in which they have a loss. And if you have ever owned or negotiate or try to buy a Toyota, they are not, they call dealership, but they are there to make a deal, but there is not that margin of negotiation. If you go buy a Camry or a Toyota Corolla, the price is set, people love them, people have faith in them, and then it shows in the record. Here you have two distributors. I try to bring you different pairs to see just different things. So you have two distributors. That means that businesses that sell stuff, that don't manufacture but are just reseller of stuff. On the left you have the one, you can look at it, it's very interesting. And on the right, you go from 129 to 533. And on the right, it's a little bit tougher on the right, minus 55, minus 22. Some stuff good in the 2000 years, and then 2012, a loss. Again, a loss, again and again. So On the left, you have, it surprised me, this one. It was Costco. Costco is a good company, well managed, and as you can see, not a strong growth, but still a growth. We'll see in the future with the competition against Amazon. And on the right, you have Amazon. So that's why on the right, Amazon is building a moat right now, but it does not show at this moment in the rising of their net income. The earning per share are not there. And we'll go back more later on, but in 2016, it's $4.90. But compared to the stock price, I will wait for that part. Oh yeah, we continue. Another example is two company in the industrial business, more industrial. So on the left, you have a company that manufactures stuff, and on the right, a company that is in the industrial but that use what the company on the left is manufacturing. So on the left, you have it's Bombardier. On the left, it is Bombardier. And if you know a little bit about the company, look at that. Not many people look at the earning per share for the last 16 years. I'm not impressed. They were making 55 cents a share in 2001, back to 8 cents to 3 cents after 9/11. It was tough. In 2004, they lost money. They came back in 5, 6, 7, 8, and then in 14, 15, and 16, the three last year, they lost money. So it's not a company that is going well in the sense of the way they are making money. They are not making money, and it's not stable, and the government always have to be there to help. It's great jobs, great brand, great jobs, great stuff. But as far as I'm concerned, when I look at the income statement, I'm not impressed. If you look on the right, it is a Burlington Northern Santa Fe. It was one of the biggest Warren Buffett's acquisition for $41 billion US in 2012, I think. Yeah, I have made up the numbers after that because I've been able to infer them from the balance sheet, blah 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 blah. But now it's more difficult to continue to make the number because Buffett has bought the company completely. So Burlington Northern Santa Fe is a train company that uses trains to transport, and they have the ability to adjust their price to inflation because in all of their contract they have a price that they charge, and if the fuel goes beyond a certain number, they have a surtax or surcharge for the fuel cost. So they're never being hit by the price of fuel because in their contract they don't transport if they don't have that part of their contract signed. So that's why they have good margins. And when I looked at Buffett began to buy that company way back in 2008, 2009. And back then, the company was public, and I went on a website and I looked up the statement and the stuff. And it was bland. It was the same thing as Warren Buffett's in Times New Roman, very, very black and white, simple. You go there, you look, you see the numbers. It was easy to read. I said, wow, that is a Warren Buffett's company. And of course, not far, about a year and a half later, he made the offer to buy the whole company. And now it is under his dominion. So it's a big company. And the numbers are there, so you can see there is a moat in the train industry. Now we have two companies Québécoises, Québécoise companies. So on the left, it was Nortel. And you can see a lot of red. And Nortel, I don't know if you have been caught into Nortel, but it was a wild ride, a lot of talks. And, I've been teaching that class for the last 12 years. And each time I always update my slides. Each year I update my slides. I add one more and one more. And I check the last 2, 3, 4 years. Because when you go on Yahoo Finance or if Google Finance, you see the number of the year, but you always see the 3 or 4 last years. And almost all the companies, sometimes you have a change about 3, 4, 5 cents per share because this adjustment, because that adjustment. It happens 2, 3 years. Some adjustment, 3 cents more here, 3 cents less there. But for Nortel, it was so funny. Nobody talked about that, but I was going back and each year, and it was completely different. All the I haven't kept all my record, but the number was so different from one year to the other year. So how can you evaluate a company if even the numbers change from year to year to year because of all that malpractice. And we all know how it ended. So to have a company that lose money every year like that and goes everywhere, it's such an investment, and anybody can do it because I don't know you, we don't know me, but we can do something like that. We can do a company that goes nowhere and that loses money every year. On the right is Fleuron Québécois, is Alimentation Couche-Tard. Couche-Tard, stay up late alimentation. So they are well managed. They were from 6 cents a share in 2001. They're up to $2.13. That's not like much, but it's a lot more. You can see by the eye, you can see the continuous climbing up. They are leveraged with debt, but not too much. They are very, I will say, disciplined, and they don't make a foolish mistake, not to this point. Mr. Bouchard is a good manager, and to date, he's going very, very well. So you see, completely, those are not in the same area, but just to show you completely two different business model, two different way of doing business, and one is going very well in the stock market, and the other one was just a bubble and then it crashed.